Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, November 30th, 5:17 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the boy that escalated quickly, quickly version of the Daily Market Insight video. Anybody that is a fan of Anchorman, you're familiar with this scene. Ron Burgundy sitting drinking a Miller Lite in his office. Actually, it's a Miller High Life, not a Miller Lite. And saying, boy, that escalated quickly. And that's pretty much what happened with the market today. State of the market, bear market rally might turn into a full-fledged rally if we can continue to get and to stay above the 200-day moving average. You can see leaders continue to be market bullish. Short term, all five of the major indexes are trending above their 21-day moving average. Medium term, they're also trending above their 50-day moving average. And today, the 200-day moving average came into play. We'll take a look at the charts momentarily, but as far as what just happened, yeah, Dovish Powell sparks huge rally. So Jerome Powell had a much anticipated speech today, and his speech was short, kind of to the point. And he wrapped it up by saying they were trending toward moderating the pace of hikes at the December meeting. And then as soon as he sat down and the moderator started asking him questions, the moderator said, "Well, I don't really have to ask 50 or 75 based on based on that last paragraph in your statement." And Jerome didn't dispute that, and the markets really took off to the upside after that. Initially, what happened is the speech, the minutes or the text of the speech is released right at 1:30 when the event started, and the markets, so the algos immediately start reading it. And they're programmed to react according to certain keywords in there, and their initial reaction was to the upside. Very often that initial reaction is a fake out, but it wasn't in this case. We put in a little bit of a handle. We'll look at some intraday charts here, and then you can see we broke out, tested it back, and then just squeezed into the close. Big rally, close at the high of the day. Here are the final numbers. G6 up. This is our 6 ETF composite of growth ETFs, up 3.7%. S&P up 3.1%, NASDAQ 100 up 4.6%, Dow up 2.2%, mid caps up 2.4%, Russell 2000 small caps up 2.7%, global diversified 60/40 up 1.9%. In-house GROTECTION, we came in about half allocated to the risk of the market, and added as the market started going higher. Underperformed today. That's what's expected. It's a marathon, not a sprint. We'll adjust our rules and our exposure accordingly as stocks leaders continue to make progress. Really what we're looking for is big liquid leaders that institutions can pile money into. The leaders of this most recent rally have been more on the mid cap and small cap side. But we might have found one today, and it's something that we owned within the last month, got stopped out of, but we got back into it today. Big move up on big volume. So let's dive into it. Then we'll do, of course, tail of the tape and charts of interest. Quick explanation to anybody new of what we do here at Revere Asset Management. You're going to hear a lot of pundits coming out now and saying, "See, this is why you can't stay out of the market, or if you miss the best days," but they won't mention all those terrible days that they missed en route to down 27%. Down 27.5% drawdown year to date. But what we do at Revere is we manage individual client accounts. We're not a hedge fund. We're not a mutual fund. We are active managers that take our cues from the market. We invest across 3 time frames and look at what leading stocks are doing. And our flagship portfolio is called GROTECTION. It's designed to grow assets during uptrends, protect them during downtrends, and there's a lot of shades of gray in there. So a lot of our exposure varies depending on the strength of the market and across those 3 time frames. Best case scenario, you've got all 3 of the major indexes stacked with the short-term 21, That's the green line above the medium-term 50-day, and that's above the long-term 200-day. When you're trending above there, we will have as much money in the market as we can possibly be comfortable managing. Then if we start to go sideways, our stops will get hit. It'll naturally take us out of the market. If the correction starts to get a little bit deeper, you're going to see the slopes of the lines of the short term and the medium term start to roll over. That's your first clue that it may be a little more than a pullback. And if we break below this black line, that's the 200-day moving average, that's when we get to a maximum defensive posture, because this chart shows what can happen if you're not prepared to defend your capital during bear markets. The 6 that are highlighted, 6 severe bear markets going back to 1968, lost an average of 44.5%. You need an 80% gain to get back to even on that. January through October of this year, we pulled back 27.5%. You need 38% to get even on that. In-house, our worst loss was about 11.5%. So we need about 13% to get back to even. Really not that difficult to get back to even when you're capitalizing, where you're compounding your portfolio from that high of a base instead of needing 38% to get back to even. So we've got various rules to get out, various rules to get back in. And if you're interested more in this approach, reach out to me. Email don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. You can also email my partner, Dan Stewart, dan@revereasset.com. He coordinates all onboarding of new clients. As I said, coming into today, based on various rules, we were about the equivalent of 50% of the risk of the market, 55% to be more exact. And started adding some things. When strength persisted, we ended the day at 0.75% risk of the market. And we'll go through our trades like we always do when we go through the tail of the tape. But you can see here, this is a big change in character on the market. We had a very slight short-term change over the last couple of days, but I've been going through all of my trades and going through the recent action. Buying weakness and selling strength has been the calling card for this market. So we'll see if that continues to take hold. Like, for example, this big move up here, the last time we got a positive CPI report, we ended up 5.5% on the S&P, followed through a day later, and then we went nowhere for 3 weeks. So if you continued to buy strength over the last 3 weeks, you probably got a little bit frustrated because things weren't making much progress. They start to pull back. They held the 21, which is key. That's why we kept our exposure at a minimum of 50%, which we do as long as we're above the 21-day exponential moving average. And then you get rewarded today with a big move off the 21, blowing through these key former resistance levels that were just busted through. The 2 key ones being 4,007, that was a big fib level that we've been talking about, and 4050, which is the 200-day moving average on the S&P 500. So now the question, quite obviously, is can this strength persist? Will we go sideways for a little while? Are we finished with the short squeeze? We're still going a little bit higher after hours today. We'll see what happens overnight and into next week. But ideally, what we want to see, and the rule, I've done a webinar on this, how to best navigate these bear markets. We want to see a 1% close above the 200-day or the 40-week moving average to end the week. That is that long-term signal to put money back to work in the market. And the last time we went to sell on this was on 4/14, when we had a weekly close below the 200-day moving average. The following week, we tried to get back above and failed, and that was the beginning of the big second leg down in this correction. Then we tried to get back above the 200-day moving average back here in August. We failed at the 200-day. That was the third leg down. Let's see what happens now that we finally made a move above the 200-day moving average and got a daily close there. We've got 2 days left in the week to see if we can hold on to it. We do have some key economic data coming out. We have PCE inflation data coming out tomorrow morning, and then Friday morning we have the monthly jobs report. I don't know if Jay Powell has the data on those, and we'll talk about some data that came out today and see how the market reacted to it. But I have a feeling he probably does, and that's why he wasn't as hawkish in today's speech and Q&A session as he was the last time he addressed at the last time he spoke at the FOMC meeting. So there's your S&P 500. Let's move forward to the NASDAQ 100, which has been the weakest. One closed below the 21 yesterday. We put a short on as soon as we started showing strength this morning or this afternoon. We took the short off, selling it piece by piece. We're all out of that now. Strong move with volume back above the 21-day. Really, all we are is 10 cents above the high of 11.15. You haven't missed anything. Plenty more room to go to the upside and still below 4% below the 200-day moving average on the NASDAQ 100. The equal weight NASDAQ 100 got back above the 200-day today, and really mid caps, equal weight NASDAQ 100, equal weight S&P 500. We talked about this on our call this morning. This has been kind of, if you've been paying more attention to these than the major indexes, this has been setting the stage for the market to really be more for the thought to be that the market is a basketball underwater, just waiting for the right conditions to take off higher. And maybe we got that condition today, but again, a lot of data left to come out. We've got, will we have a recession next year? How difficult of a recession will it be? There are tech layoffs by the tens of thousands taking place across the country. On the other hand, United Airlines, or maybe it was Delta, said they're going to hire thousands of flight attendants next year. So their outlook is pretty good. The consumer, well, then we'll talk about the data when we get to the tail of the tape, but the consumer data that came out this morning was mixed. That basically the consumer is strong. GDP was very strong, but there was some manufacturing data that was on the weak side. And what flows through, what's accounted for in the market, nobody knows for sure, but we do know that the market is a forward-looking mechanism, and discounting what's been happening in these big FANG type stocks that have been weighing on the NASDAQ 100 and the S&P 500, all in all, the average stock looks a little bit better than they do. Let's go to the Dow Jones Industrial Average. You can see making a new high, going all the way back to April, first of the indexes to do that. One closed below the 8 yesterday, big move today. Notice the lagging relative strength. This is actually a good sign. You don't want defensive stocks leading when the market is rallying. The Dow did take hold of leadership here during this last move up, while the FANG stocks were getting kicked in the teeth and the NASDAQ 100 was lagging. But now over the last couple of weeks, it just went sideways, and the relative strength line lagged a little bit relative to the S&P 500. And then making new price highs today, but not on the relative strength. But this is, I'm fine with this. If you participated in this Dow move up, congratulations to you. You've done very well, and we've stayed in oversold territory for 5-6 weeks here. So the Dow looks fantastic. Let's go to mid caps now. Mid caps still haven't cleared their August high the way the Dow has, but this has been more this sideways action here after the 2 days up. Relative strength in line with the S&P 500. This is more indicative of what's going on with the market, making new recent highs, not quite August highs though. So that looks pretty good. Small caps have been lagging as of late, up 2.7% today. So yeah, they lagged the big cap index as well. They lagged the Dow and the S&P, but that's because those FANG stocks were really being squeezed today. That's why the NASDAQ ended up 4.5%. But the good news is the Russell back above the 200-day moving average. We want to see it stay above. Let's quickly break it down into the growth and value components here. Even IWO, which is a component of the G6, got above its 200-day moving average. The value side, IWN, also above its 200-day moving average. So IWN lagging a little bit here. You're going to see both of these lagging relative to the S&P when I go back to the IWO, but that's just because small caps had been lagging, and it's been mid caps really that have been leading. Mid caps, big Dow type stocks, and more going with the equal weighted S&P and the equal weighted NASDAQ 100 has been a better way to go. Semiconductors are a big component of the NASDAQ 100, and you can see they've been acting much better or much closer to the 200-day moving average than the NASDAQ 100 is, but not quite as big as the equal-weighted NASDAQ 100 relative to the 200-day moving average. So let's take a look at a couple other things, and it was very interesting today watching the dollar intraday. Started out with a gap down. This really didn't equate to what was going on with the indexes as they opened near flat. Then as the dollar started strengthening, the indexes started coming off. But then you can see the reaction to the dollar with the release of the Powell speech and just waterfall to the downside. And this corresponds, of course, with a move to the upside in the SPY. Just the inverse correlation with the dollar and the S&P very firmly intact. Let's go to the VIX now. And the VIX has been, people have been saying that the VIX has been broken, but by the rules that we follow, seeing it down here beneath this 24 to 26 level is what we wanted to see. Below the moving averages is what we wanted to see. We were concerned about a bounce, and it still is in oversold territory, but it pulled back today in sync with what the indexes were doing, and it's low value here down near 20. Now we need to see how it acts relative to August and relative to April, along with how the indexes act as they get into those highs. Let's see, we did the VIX, we did the dollar, we want to do bonds. BND, this is a broad bond ETF. Bounced off the ADMA, higher highs, nothing wrong there. Junk bonds, also fine, actually making a higher high as well. This means that there's no fear in the high yield land as far as performance of bonds that are rated quote unquote junk or high yield. What else do we want to show? We want to show gold. I got shaken out of GLD 2 days ago. Gold had a nice day to the upside, which you figure it would with the dollar coming off. Note the stochastic curled up. That's another thing. The stochastic on all of the G6 and the indexes curled back up today with the powerful move. Bitcoin, a decent day as well. Let's go to the 60-minute chart. A little bit of the fear alleviated from what's going on in that creep scam Bankman fraud is being interviewed right now on CNBC. I'll have to watch it later, but from some of the things that I read, it's just kind of infuriating what this clown is getting away with. His face just screams punch me, I swear. And what he's done to people's accounts is just I think my emotions let you know how I feel about that. So did we cover all of the key charts? I think we did. So now we're going to get into the tail of the tape and see what's changed, and then we'll go through some individual charts. So note from a technical standpoint, the indexes in the G6 pointing up now. Dollar still below the 21. The yields, oh yeah, I didn't show yields. And something I discovered, sometimes the TLT and the TYX are out of sync. TYX, this stops trading at 3 o'clock. So if you look at an intraday chart on this, it had a sharp move up into 3 o'clock and then it just stops at 3 o'clock. But if you look what TLT did, and it should be the opposite, TLT going down and then up here at the close, that's explains why TLT is up today, but also the yield was up today, and that hour in between accounts for that. TNX, I hope I explained that well enough. TNX, the 10-year, you can see down today. That's the yield much lower. I believe the yield curve got less inverted today from what I was reading. So tail of the tape. Put call spiked right around 130 up to about a 1.4, and that's good. There's still some fear in the market, people buying puts, but then they got to get rid of those puts, and that's responsible for the squeeze, the puts and the covering of shorts in the indexes, and that's why you squeeze so violently. VIX dropped 6%. Fear and greed spiked up to 70. When you get into extreme greed you got to get a little bit of concerned. Really, this is still kind of neutral. Moving on, bull case, still operating under that bull case as we held the 21 on all the indexes except for one close below on the NASDAQ 100. Now, the mixed data that came out, ADP data was weak, and that initially popped the markets. Then strong GDP came out, which brought the markets back to flat pre-market. Then after the market opened, JOLTS data was strong, which means that there's still a demand, and that impacted the markets. And so there you're seeing JOLTS and ADP data conflicting. And then PMI came out, and that was weak. So that conflicts with what the GDP showed. But the bottom line is everybody was waiting to see what Powell was going to say at 1:30, and his dovishness took the day count from down 2 to up 1. These were the pivots. This is where we were trading when his speech started. So this is really a stop area for any new longs, and that's 39.50 on the S&P 500 and 281.50 on the NASDAQ 100. Expectations were neutral coming in today. Not sure what the reaction was going to be, but up through all resistance areas and the 200-day moving average on the S&P and this 290 resistance area and this fib, this 286.82 fib. So any pullbacks should be contained by this 40, 50, and 200-day and this 286.82 fib at a worst case to keep the rally intact. Sectors up today. I don't know that I updated this. Gold, solar, and biotech. Yeah, those were all strong today. Emerging markets also strong as there's continued talk that China is going to relax its zero COVID policy. Oil started out strong, got weak, and then strengthened with the dollar coming off after Powell started talking. Cyber stocks were weak, ended up positive on the day. They started out initially weak. Actually, all of this can be switched to at least neutral in color because of how things bounced toward the end of the day. They so underperformed on a relative basis, but not actually red on the day. Banks. Banks, cybersecurity, as CrowdStrike had a brutal reaction to its earnings report, and real estate, XLRE, that also bounced. Everything bounced very nice. All 11 sectors finished positive. The weakest was XLE, up just 0.5%. So here's our focus list. We'll look at these charts. As I said, portfolio in-house, we upped our exposure from adjusted beta of 0.55 to 0.73, so basically 73% of the S&P 500. We covered our short. The net loss on this was 0.25% of the overall portfolio, very manageable. Trimmed half of our GFS as it broke the 21-day before Powell. Just can't take a lot. Couldn't take the gamble. We hit our loss on that at negative 0.1%, and you just, when you're down, yeah, I got shaken out, quite obviously. You never know what the reaction was going to be to Powell, but we protect the downside first. We know the returns will take care of themselves when a bull market comes back. And then on the buy side, 2+2 on Netflix, which had a really nice reaction today. Really, it was strong all day before Powell spoke, and then it really took off to the upside, and we'll look at that chart momentarily too. So the bottom line, Dovish Powell sparked strong rally up through the 200-day moving average. We'll probably update this to see what the next resistance area to the upside is, but at this point we're more concerned with a pullback, and will it hold the 200-day moving average, that 4,007 level, but most importantly the 200-day moving average, which is around 40.50, and we'll look for that to flatten out and then eventually turn up. And this is another benefit of using that system we've done that webinar about, is getting back in. We were all the way up at 4,500 when we failed the last time and we got the sell signal. You get back in all the way down here at 40.50, so 10% lower, but triggering a buy signal versus where you were stopped out at. And that's another benefit of getting out of the way when you're under the 200-day moving average. Not to say it's completely perfect. There are a little bit of shakeouts here, but when you can avoid a 27.5% drop because you're under the 200-day moving average and the slope of the line rolls over, it's certainly worth the not losing sleep knowing that you do have rules to get back in. So let's go to some daily charts now. And We'll start with the buy that we did today. So Netflix strong all day. I got an alert yesterday. We were out of Netflix. So we bought this back here, got stopped out when it went back below the 200-day moving average. It was very, very frustrating, this trade, because we go by price and volume. Volume was there along with the move up for several days above the 200-day moving average. We hit this 305 area and we just started dripping lower for a week and a half. It was very frustrating. We got to obey our stops. We got below the 200 and we got stopped out at the beginning of November. Then volume came back in. It took it off to the upside, made a fool out of me. But then look how it started selling off again. And this was even while the market was going sideways to higher over the last 3 weeks. And I got an alert below the 21 this morning for Netflix, and I reset it to tell me if it got back above the 21. And then early in the day, my alert went off on this. So I started looking at the daily chart of it. And sure enough, it was outperforming what the indexes were doing. And I was particularly impressed with this move up here. And we actually took half of, when we got stopped out on GFS, I wanted to replace that with something that particularly was liquid, because institutions love these big liquid stocks that are acting well to pile into. So I bought 2% before Powell and another 2% after Powell. And this was just showing strength and volume all day. The volume was well above this sell-off volume over the last couple of days. And I mean, I have a mental note to myself to never ignore big liquid stocks when they're moving on volume. And that was what led me into the first 2% buy on Netflix and the second 2% buy. This is one that we can take up to 8 to 10% if it continues to act well, because it's easy to get in and out. I like the stochastic coming off from overbought to at least mid-level before hooking back up. So maybe this has room to run, and if so, we got in at a nice place right off of the 21-day exponential moving average. The stop out on GFS, on the other hand, not as happy. Was selling off with volume below the 21. That was the third day down, and I knew when I sold it, I said, you got to obey your stop, but wouldn't be surprised if this reversed back to the upside, because and again, post-trade review will lead to if we need to make any adjustments to our sell rules. But sure enough, bounced off the 60 area and right back up above the 21 on above average volume. So we still have a half of it. That's the good part of it. And it's easier to add to an existing position that you're profitable on, as opposed to getting completely stopped out and having to reestablish your position when you've got when you sold at a loss. Easier to say to get back in, not always as easy to do. So those are the portfolio changes, and then of course we got out of QQQ as the QID short as the Nasdaq 100 just started rallying after Powell. So let's go to the focus list now, and let's start off with ANET. This was again at the top of the buy list. I was more focused on Netflix today and getting out of QID after Powell than I was adding to exposure. There'll be time to get back into this if this is going to continue to lead, but a nice low risk entry would have been at a recapture around 135-ish today. ANET, next up is GFS. We already talked about that. IBKR, the brokers continuing to act well, is getting back to the top of its handle. Nothing really stand out about the volume or the price action today. In fact, it was barely higher, so it lagged on the day. Apple had the alerts set at the 50 and the 21-day moving average. They triggered on the way back up, so reset them, because we absolutely want to know if Apple is going to hold this 50 and the 21. Such a big stock, very key. Big concerns about the number of units it's able to sell with what's going on over in China, but we will see how it continues to act. While I'm at it, let's look at Tesla, because it was up the most on the day of the big FANG stocks outside of Netflix, and it reclaimed its 21-day moving average on above average volume. They also announced they're starting their semis, and they're going to start rolling off a bunch of models off of out of the Austin Gigafactory in the first quarter. So again, institutions, if this market has legs, love to pour money into these big liquid stocks, but we don't want the chart to be too broken we'll prefer better charts of liquid stocks, but we'll see how they act, and we'll be weighing all the sectors against themselves and other sectors as we move forward if this rally is going to continue. Okay, back to the focus list, ASO. Putting in a nice little 3-day handle, not overly excited about what it did today, but it did need this handle. It's been acting very well as far as retail stocks have been. Numbers not as good lately, but the PE is down to 7 on this. It was much higher when it was a growth stock, but the consumer apparently spending is still strong based on what GDP showed, but that is actually a contrarian indicator to what Powell wants to see if inflation is going to be cooled. Then a couple of oil stocks that we noticed, and I wanted to point out what was nice about these. Oil was up pre-market, and pre-market this Schlumberger was back above the 21. It reset the stochastic by coming into oversold. So getting into something coming back up through the 21, just coming off of oversold, it's like you get, they say the bird in the hand is worth 2 in the bush. It's like you're getting 2 birds with this. The more boxes you can check on the plus side of a stock, the better. Yes, I see the relative strength lagging on this over the last couple of days, but we'll see how it goes. It was a former leader, acted very well. Was just time for it to correct after this big move up from 33 to 56. This is a very normal correction after that, and you have to account for that when looking at the relative strength line. But a move back up through the 21 and the resetting of the stochastic. I think that looks pretty good. Also, Halliburton, this actually led today. Same thing. It's pulled back from the top of the handle. Stochastic looks a little bit better. Relative strength relative to the 21-day moving average looks a little bit better, and the price action was better today. So Schlumberger and Halliburton and oil services. And I want to go to those 3 leading stocks to see how they acted today, that the 3 recent leaders of this move up. So ELF yesterday had its first move below the 80 MA, but what's been happening lately? Buying weakness has been what's been rewarded. Reclaimed it up 2.4%, average volume today, but this certainly stopped the bleeding, and you've got a good reference if you get into this. It should hold the lows of the last 2 days if this rally is going to continue to go higher. And then SMCI, but again, that's not an overly liquid stock. We're preferring things that are more liquid. SMCI, the big winner, riding the 80 MA higher, just the way we like it. Big shakeout today on this. Held the 21, but it was selling off all morning. Looked like a change in character, but money came back into it just the way it should when the market righted itself after Powell and closed back above the 80 MA. So no closes between the 80 MA. You got your shakeout, and your risk is to the 21-day, which is 8% down if you decide to take a plunge here. Obviously, with it hitting the profit plus 20% target, this is something that O'Neill would be saying it's time to sell instead of buy, but that shakeout could offset the fact that you should be selling it there. Of course, it has been overbought for a while. There is never any perfect scenario for a stock that's going to show strength, not overbought, and not superior relative strength, and that it's going to be due for a pullback. But bull markets are just different. I showed on the stochastic on the S&P compared 21 to 22, and you just spend so much time in overbought territory when it's a bull market that you just don't get concerned about it. Overbought and oversold are more concerns for when the market is trending, is going sideways, not when it's either bull or bear. And finally, the last stock today is AEHR. Didn't really do much at all today. If you look at this, it was just another day at the office for it. Only up 0.5%, consolidating near the highs. But again, this thing ran from 1760 up to 27. Big move up, and it's just working that off right now. I bounced off the 21 here 2 weeks ago. That would have been a nice entry point. It's a volatile stock. It's on the thin side, so prepare accordingly. That's going to wrap it. As always, love to hear from you. Email is don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the market, it's how much of that you can keep. Now that we've preserved capital and dodged the bear market, now we get ready to see if we're transitioning into the bull. This is the very clear change in character on the S&P 500 that we're back above the 200-day moving average. We still have 2 days to go in the week. We want to see more strength, and then we want to see consolidation, kind of similar to what was shown over the last 2 weeks after the strong 2-day up move after the last CPI report. More economic data coming out the next 2 days, so we got to see how the week closes. But this is getting back above the 200. Really didn't pause for an extended period of time intraday. We hit it, we backed off, we hit it, we backed off, and then we went through it. If you look at the intraday chart, it didn't spend a whole lot of time there, either at 4,007 or at this was at 4050, and then it back tested it and blew through it. And the short squeeze, the squeeze has a lot to do with it on a big day like this when the market is flashing. You've always got bears trying to make money on the short side, but when they get off the short side, they do it quickly, because not only are you losing money, you're missing out on gains when you've got money allocated on the short side. That's why those squeezes are so violent. So wrapping up Wednesday in the month of November. This is Don Vandenbord telling it like it is. Thanks for listening. Have a great day.